Hey everyone, hopefully you're having a good day. My name's Andy. My channel's Finding Value. Today I'm going to go through Twitter, see what people are sharing on social media. I'll interject my financial opinions as we go through it together, generally related to three different topics: wealth building, commodities, and/or financial topics. Let's dive right in, take a look, see what's going on today. If you want to follow me at @Score Finance, if you want to join our community, finding-value.com, where I dive deeper into all these topics, subjects, looking for investment opportunities, sharing those opportunities with everyone in the community. I do that through midweek updates on Wednesdays and Q&A sessions on the weekends. We've got a special coupon code, 50% off the first month only on a monthly membership, and a larger discount on the yearly membership. And you can always swap from a monthly to a yearly or go directly to the yearly if you'd like to sign up. So starting with Brandon, he says, we're just getting started. Critical minerals are staring down the barrel of a 5 to 10 year bull run. I agree. I actually very much agree. Rare earth minerals are included in that critical mineral area. And rare earths did outperform gold and silver last bull market. Not a lot of people know that. And it wasn't just a little bit of outperformance, it was a smashing. It was a smashing outperformance of some of the rare earth metals that are used um, in these renewables. It says here, this draft list of critical minerals provides a clear science-based roadmap to reduce our dependence on foreign adversaries, expand domestic production, and unleash American innovation. Yeah, that's a mouthful there. That's a mouthful. Now, I don't know how much I believe half these people from the government and what they say. I've seen some pretty weird stuff going on this past, I don't know, I'd say year or more going on with, you know, governments taking stakes in companies, some of this tariff stuff, the tariff on, tariff off approach, copper going down over 20% in a single day. It seems kind of weird. So, Tim Hack, I think we're right in front of a massive gold melt up. The market is anticipating this now, took long enough. Miners are showing strength despite gold just moving sideways. But the bigger the base, the higher in space. We could trade a lot higher in less than 2 weeks. I know I've said this 2 weeks ago, but this really is an inflection point level here. And once we break this, we will moonshoot, or moonshot, I should say. And obviously, he's got a chart of gold here. The higher lows coming up into resistance, and I agree. I think we're going to break higher. I agree with that. What I would do, the way that I view the markets, and I think this is just a little bit different than everyone else. Everybody wants updates like this guy, Tim Hack. They want to know where the price is going to go and how high is it going to go and how fast and all these different things. Let me let you in on a little secret. He doesn't know how long it's going to take. That is a projection, and projections are, they're not always right. So what I think is a better mental model, I don't know if it's a mental model, I'll call it a mental model, is to not have expectations and just say, you know what, we're up against resistance, we're trying to break out, and don't put any time frame on it yet. And don't put a gigantic move higher. Just say, you know what, I think we're going to break out and I think we're going to move higher with time. What I do is I look at the conditions that gold goes up under. And I think those conditions are present where there's two big conditions that I've noticed in history. One is increasing interest rates. Gold is a viable alternative outside of bonds. And if we have an increasing interest rate environment, that means people are selling bonds. So one environment where gold does very well under, in my opinion, is when bonds go down, which means yields go up, and it's used as a investment instead of bonds. Another environment that gold has done very well under that we've seen in history, it's called the safe haven asset. And that safe haven asset, it earned its name by basically the yield curve uninverting. So when the yield curve uninverts, unemployment goes up, and we see that type of market condition. Gold generally goes up under those conditions, not if there's fear in the market and it's a sell everything event, but it front runs money being printed for the next cycle. So usually interest rates need to be cut. Gold does very well anticipating before they even get cut. It front runs that cutting, and then it goes up during the cuts. And then we could get maybe a strong pullback during the cuts if they're cutting interest rates because of unemployment. And you can always get a scare during that. But that's generally when gold does really well. And we have both of those conditions being met. We have a breakout of the 40-year downtrend of an increasing interest rate environment, which is good for gold. And then we also have kind of a unemployment yield curve potentially uninverting. We'll watch it. And then we have interest rates potentially going lower here too, which is all good for gold. So all the tailwinds that gold could potentially have could be active here any second. So we could see another big run. So I look at the things that back. What are the tailwinds for gold? If the tailwinds exist, I just stay long, guys. It doesn't. The patterns will work themselves out. The consolidations will consolidate. If the conditions are still there for this to go up, I stay long. Garrett Goggins says Saudis are selling U.S. Treasuries and buying silver. Saudi Central Bank purchasing shares of SLV, iShares Silver Trust. They also made another investment in silver, see below. The Saudi Central Bank recently invested $1.368 billion into the U.S. financial markets through new purchases of USA securities. Listed below is the top 50 holdings. It appears most of it was passive investing into ETFs and index strategies. Was this part of the Trump administration's announcement of Middle East investment into the USA from earlier this year? The $30 million invested into SLV represents a 2.23% overall allocation into new investments, top 50 holdings. See highlighted section below. What is interesting is the purchase of SLV is not the only silver investment. SIL was also purchased, almost $10 million invested into the silver mining ETF. See highlighted section below. It appears silver is gaining traction among institutional investors and some of the things that they're invested in. I don't know if you guys know this. Go back and watch the movie 1981. The movie is called Rollover. In the movie, what they were trying to do is make sure that Saudi Arabia didn't sell out of their U.S. treasuries too fast or move money too quickly into buying gold. And then I'm reading this, I'm like, oh my gosh, this is just like Rollover in the movie that was produced in 1981. Saudis are selling U.S. treasuries and buying silver. That's the first thing that popped into my mind was that movie. And check it out. Check out the movie. Rollover 1981. You can hear them talk about the dollar holding, Saudi shifting money potentially into gold investments. It's just very similar to the situation that we're in today. Anas says this is one of the most important charts and predictions in OPEC's outlook to 2050. Follow their account, agree or disagree with their predictions. The info is useful either way. So the road, transport, petrochemicals, and aviation are key for future oil demand growth. The transportation sector accounted for more than 57% of global oil demand in 2024, and with minor variations is projected to retain this share over the entire forecast period. Within this sector, the largest incremental oil demand is expected in road transportation and aviation, adding 5.3 million barrels per day and 4.2 million barrels per day, respectively. A significant demand increase of 4.7 million barrels per day is also projected in the petrochemical sector. So here's global oil demand. You can see the demand in 2024, 103.7 million barrels. They are projecting demand in 2050 to be 123 million barrels. We've got other aviation and road making up a chunk of that. We've got petrochemicals, other industry, and residential commercial agriculture 2.3 electricity generation going down just a little bit. So that's what's going to make up the difference here. The question I have is, can we produce 123 million barrels of oil in 2050? I don't know. I don't think so. Not of oil, at least. Maybe of natural gas liquids and everything. Maybe. I think that's even pushing it. We've got novelism here. It says, avoid skeptics for your early hires. You want optimists with good judgment and execution skills. I think that also goes for investing. You don't necessarily want to be skeptical. You want to be an optimist. You don't want to be a blind optimist. You want to be someone who has good judgment, can execute based off of not emotion, but logic. And then you want to be optimistic that something's going to work out in the end because that's what allows you to hold. If you're really skeptical of everything, you don't set yourself up for becoming a good investor. You tend to sell way too early if you're skeptical of everything. Their pessimism is your opportunity. Yes, 100% right. When you have negative sentiment or people are pessimistic, that's your opportunity to buy. When people are not there, that's your opportunity to buy. When everybody's leaving the sector because it just hasn't gone up for 5 years, that's your opportunity. Charlie says the stock market average total return is 10% per year, but don't mistake that for consistency. Over 97 years, returns were within 2% of that number just 4 times. The lesson here is compounding comes in lumpy, unpredictable bursts. So this is what's called a normal distribution curve. And this is what you should take from it, right? You can see on the left-hand side there, over here, right? This is your opportunities over here. When you get these big crashes and falls, that's when you want to load up. Because if you notice, 1932 or 1933 is over here on the 40 to 50% increase. So 31 was the minus 40 and greater pullback. And then you had 32. Let me see where 32 is here. 32 was more of a flat year. It's right here. Then 33 had a massive up move from 40 to 50% that particular year. So the opportunities are when you get to the left-hand side of this standard deviation. Then you move all the way back to the right-hand side and move over here. And that's what you have to understand about the game. You want to buy when things are down, when people aren't looking, when people are pessimistic. I went through 2008. I was 27 years old. Yeah, I just turned 27 when we had that crash. And again, I didn't know that much, but I knew a lot of people who sold out at the bottom of 2008 and moved all of their money from stocks into like stable value funds. And I'm like, all right. I mean, I didn't really know what was going on necessarily. I was just kind of watching everything, observing. But there was a lot of people that got scared out of that market. And, looking back, they should have done exactly the opposite of what they did. They should have taken everything out of stable value funds and put them into investments in 2008 and 2009. Let me see where 2009 is on here. 2009, I don't think it was a huge year. It was pretty much, I'm looking for 2000. Here it is, 2009, 20 to 30% increase in 2009. 2008 was down 30, 40%. That was your opportunity there. 2008 to really load into it. I didn't know what I was teaching, what I'm teaching now, which is ratios, technical analysis, and market cycles. I didn't know any of that. But going through that experience, it basically led me down the path of saying, I need to learn this myself. But normal distribution, get excited when things go down, not up. That's the takeaway here. Charlie says, you do get an occasional opportunity to get into a wonderful business that's being run by a wonderful manager. If you don't load up when you get those opportunities, it's a big mistake. And Charlie and Warren Buffett, they're more in the camp that you want to concentrate positions in your best ideas. That's kind of what their opinions are. Investing quote of the day: nothing so undermines your financial judgment as the sight of your neighbor getting rich. Yeah, there's a lot of people that don't like that. To me, I don't really care. It doesn't matter to me. If someone's making money faster than me, that's fine. It doesn't bother me. It's not going to change my strategy. I kind of view investing like lifting weights. There are people who might get stronger than you. Maybe they go on gear, or they take steroids or whatever. But I'm not going to do that. That's going to hurt you in the long run. So I never got into that stuff, and I kind of view investing like that. If you keep doing things that are highly leveraged, you're going to get hurt in the long run because at some point you're going to just get blown out. And it's you're going to gamble, gamble, gamble until you get blown out. So I kind of just avoid that strategy. I just avoid it altogether, and I just keep riding and buying under valuation, holding on, and just ride the dang thing higher over time, and buying stuff that's out of favor constantly. Here's a couple here. It says, you must have the discipline and temperament to resist your impulses. Human beings have precisely the wrong instincts when it comes to the markets, says Walter Schloss. Peter Lynch says, it's crucial to be able to resist your human nature. So you make money, guys. You don't want to, you have to train yourself. You have to understand when to buy things and when to avoid buying it if you're a long-term investor. Ian Castle says, new article here. It says, in February of 1999, Stanley Druckenmiller went short technology stocks. The bubble was obvious to him. 1 month later, his loss was $600 million. He threw up his hands in anguish, closed his short position, and ate the loss. Just 1 year later, technology stocks were still ripping. He couldn't take it anymore and went long. Quote, I bought the top of the tech market in March of 2000 in an emotional fit I had because I couldn't stand the fact that it was going up so much. I put billions of dollars in within hours of the top, and boy, did I get killed the next couple of months. It is maddening watching other people make money in stocks you passed on. The worst is when those other people are your friends. So I'm going back to this quote up here. Stanley Druckenmiller fell victim to that. So how do we prevent ourselves from falling victim to it? The only thing I'll say is, do not chase price, chase value. Go where other people aren't. And if other people are bragging about their gains and they're just regular people, they don't know the markets that well, don't worry, don't listen to them. Let them be. Play your game that you understand. Play the game that works for you. I mean, that was a rookie move that Stanley did, and I'm sure he's talked about it, where he was basically right. He had his timing slightly off on the short, and then he piled in because he had FOMO. So how do we prevent FOMO? Don't buy overvaluation, period. Do not buy overvaluation, ever. A lot of people will talk, they'll ask me questions about companies that are up a lot. And let's just say price to book values are 9 or 10. Do not buy overvaluation. Protect your capital at all costs. Think of strategies where you always buy something that is of good value and then have the patience to let it turn and get into a different market condition. That would prevent him from some of these losses. I don't short things either. I don't short, I don't try to do that game, and then I don't try to chase things. Now, some people, they're going to ask you, how come you didn't invest in this XYZ? You don't need to make money off of XYZ. I don't care if it goes way up. It doesn't matter. Play your game, play what you know, play the hands that you're dealt, and play them as best as you can. Don't chase things. And if you chase things, that's where problems come. That's where big losses can occur. Question to all fellow gold, silver, and mining investors. Where do you think we are in the cycle? In my view, somewhere between growing media attention and the first signs of real enthusiasm. The best is yet to come, the big long. The big long. So where are we in the gold and silver space? Well, it depends how you define it, but and what if you're using junior companies, if you're using senior companies, or if you're using the metal itself. I think that over here is where we're at in gold. I think that silver is more down. Like I don't think. Let me think here for silver. Silver, we're out of the bear trap. We're coming into media attention, is where I think we're at, and gold's a little bit past that. Some of the junior silver companies are coming out of bases, so they came out of a base and they did a retest. I think we're coming out of the bear trap. We're like right at the bear trap coming out of it. So this is wave one and this is wave two. Wave three is up here, and then we get a sideways chop here in enthusiasm, and then we have a big blow off top. So I think a lot of them are at the bear trap, which are still really good entry points. As you go up, risk goes up. And when you get up here, this is the riskiest time to buy something. That's when you don't want to enter, is when you start getting towards the greed, delusion, new paradigm. Your risk reward is all jacked up there anyway. You shouldn't be there. So you need to learn that you want to be either in the takeoff stealth phase, which is a bottoming pattern, or you're getting in at the bear trap, which is after the first sell-off, which is in Elliott wave, is a wave two pullback. And then you just ride this whole wave up the top here. Grady says, been posting many charts that show that this lifetime commodities opportunity is about to once again go into overdrive. Been saying and posting that a big move in the TSX venture is coming, and it's now started. This ratio chart below caught all previous big up moves. This chart also shows how historically undervalued small, mid-sized commodities companies still are versus the commodities index CRB. So think GDXJ versus gold, SILJ versus silver, and URNJ versus SPUT. And these are in the spots that I like. I like these. Many will talk like they saw this coming, but they did not. Go with the service that has actually been on track all along, blah, 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 blah. Okay. So CDNX versus commodities, there we are breaking higher, looking pretty good. In a 24-year bullish falling wedge, and hopefully we can break out of the wedge at some point and break out of this pattern completely. That would be pretty sweet. And if you purchased down here, well, heck, you are making one heck of a return if you can hold all the way through that. Lucas says, most people are chasing whatever's hot. I am not. AI, meme stocks, crypto, but there's one sector that's been left for dead. Old school energy, oil, and gas. Man, this he's speaking my language. Nobody's talking about it. Nobody's trading it. Institutions have moved on. That's exactly why I'm interested. Physical oil markets are tight. Diesel inventories are 18% below average. Crude inventories are 9% below normal. Shale production is peaking. No one's completing new wells. Meanwhile, prices are stuck in a boring range of 65 to 75. Everyone's ignoring it. That's how bottoms are made. You know what? I like it. I think he's right. I think that oil is probably the second best opportunity that oil has ever been in history is right now. It's the second best in history. Think about that for a second. And it's a variety of things of why I think that. Morgan Housel, if you want to do better as an investor, the single most powerful thing you can do is increase your time horizon. Time is the most powerful force in investing. It makes little things grow big and big mistakes fade away. Time is your most powerful force in investing. That's what I've done. I've taken longer time frames and then exploit the people who are trying to make money in the short term. I buy their shares when no one's looking, like energy. Here's another one from Grady. As posted a month ago in the linked post below, miners are breaking out versus gold. And since then, miners are moving. Many miners are up several hundreds of percents from their bear market lows. But that is just the start. Fortunes will be made. GX versus gold, just starting to break out. Am I participating in this? Yes. Yes, I am. And I've got an okay allocation to it. It's not everything, guys. I don't play one sector all in. I play multiple sectors. But here we are. We are breaking out. Your opportunity is going to be behind us if you wait as this continues to go up. We've got Arctic here. Crude tankers are going from strength to strength in an unusually early start to the high season. VLTCE earnings are back in the USD 50 to 60,000 per day range after surging last week. The strength in refinery demand is obviously key, as is the reported shift in some Indian refiners' buying pattern away from Russian barrels and towards the MEG. And that's where I'm going to end it, guys. That's all I've got for today. So give me a thumb up for the content. Subscribe to the channel if you'd like. Special is the coupon code over there. And that's all I've got for today. So we'll catch you next time. This is Finding Value.